things are pretty bad. In fact, they're actually really bad. The credit crunch has sent our economy into a tailspin. Stocks are off as much as 40% on the year, if you're lucky, and the government has asked for nearly $1 trillion to set things straight again. Uncertainty is the watchword. Now, software and technology have not been immune to the downturn. In fact, tech companies in general have taken a bigger hit than most of the rest of the S&P 500. Higher betas are driving that, of course, in large part, but I think that there's also a fear that we're entering another post-dot-com era. An era where big businesses rip out their server farms, tear up their enterprise software licenses, and slash their IT spending. Doesn't sound very attractive, does it? Maybe that will happen again. You know that JMP Securities surveyed technology buyers at the end of the third quarter and found 74% would keep spending flat or actually cut their costs in 2009. That's 3/4 of the potential buyers of software and other enterprise technologies are going to keep their budgets flat or cut them. You look at the financial services software, and that number is a lot easier to believe. Of course, I don't need to tell you either that a lot has changed since the dot-com bust. Technology and innovation have brought us software as a service, open source initiatives, and cloud computing, for example. More importantly, perhaps, has been the relentless march of software consolidation. The weak have been gobbled up, leaving fewer potential take-private opportunities and fewer strategic acquirers. It's a complicated time in private equity. Fortunately for you, we have a panel of investors who are trying to work through these problems each day. From left from right, you have Dave McGovern. He was the founder of Marlin Equity Partners, which closed its second special situations fund at $300 million last year. Congratulations. He typically writes $10 million to $25 million equity checks for software companies that have anywhere from about $10 million to $200 million in revenue. About half of his deals are corporate divestitures. John Cooper is just to your right, his left. He was on the buy side for 15 years before sliding into his current position as the co-head of software and technology services at the investment bank Montgomery & Company. His firm advised 40 transactions last year. Paul Barber closed on his firm's $600 million sixth fund last summer. Congratulations, Paul. His firm, JMI Equity, looks to be the first institutional investor in each deal it pursues, typically putting $10 million to $60 million to work at a shot. It's made 6 investments so far this year, according to our data. Is 6 right?
Sounds right.
Okay, sounds right. Josh Tanzer, all the way down at the end, a stranger almost, as far as the eye can see here, gets people money. That's what he does. Whether that's growth financing or sale to a strategic buyer. His job at investment bank Revolution Partners, needless to say, in this environment has gotten a lot harder. But he still finds time to support the arts. If you have a minute afterwards, ask him about the program he works with to support arts education in the Los Angeles public schools. Sounds like it's a good thing. Okay, we're going to keep this very simple. This discussion will be broken down into 4 sections. We'll open with a few general macroeconomic questions. Then we'll talk about how the recession affects both tech banking business and the tech buyouts business, since we have both bankers and buyoutsers. Buyoutsers, is that a word? Okay. Bankers and buyoutsers. From there, we'll move into the third and final part of our discussion. We'll ask the panelists to go into a little bit of detail on the technology markets and the companies that they're working with. So that's 3 parts: macro, micro, and then software. The fourth part is the part that I'm relying on you for. That's the questions part. We'll get to that at the end. Let's begin with some macro questions in the first part of our series here. At the Super Return Conference in Dubai last month, Henry Kravitz said, despite aggressive steps by governments around the world, investors and business confidence remains shaken to its core. Understatement of the month. What would it take to bring that confidence back? I'm looking at you.
I'm no economist. What would it take to, what was the question?
What would it take to, I tell you, that's when you know you've had too long of an introduction. The question is, what would it take to bring investors' confidence back? Dave Montgomery?
Investors' confidence in technology companies?
Let's talk about the markets in general, and if you'd like to talk specifically about tech companies after that, that would be appropriate.
Well, I think it starts with the economy. So, you know, if we're going to get the investors' confidence back, I think we need to see some stability in the economy. But, you know, it's not not the way we approach businesses in terms of how we invest. We're not, you know, we start from the bottoms up. So we're generally focused on specific situations with companies in particular, and less focused on what's going on from a macro perspective. So, you know, in this market today, you know, whether you're going to have a long-term, you know, long downturn or a shorter downturn is less relevant if you're buying the types of companies that can weather the storm. So we're focused on businesses that have some level of stability in their revenue streams. And so, you know, from our perspective, there are businesses out there that are going to get hit, and they're going to get hit hard. We've seen it in the consumer space and consumer spending falling off a cliff. You're starting to see it in the in sort of more enterprise-driven businesses, as you know, especially in the tech side, where you have license sales drying up. But the types of businesses that weather the storm pretty well are businesses that have high recurring revenue streams, mission-critical products or systems, things that are very difficult to rip out in a tough environment.
It sounds like you're saying if the Dow could stay within maybe 300 points in any given day, that would be good for confidence?
I'm saying, you know, I'm with everybody else losing my money in the stock market and hoping to make my money in my investments that are more, I think, finite in what we focus on and less macro-driven.
Good luck with that. John, what's your take? What would bring investors' confidence back?
Well, I think it depends on what kind of investor you're talking about, Alex. And you know, Dave made a good point. If you're talking about your own personal investment portfolio and you're investing in tech sector or in any broad sector, you'd like to see some kind of a floor, you know, whether there's some kind of a support that's mandated or some created floor somehow in the market so that you have confidence to come back in. I think with respect to the people in the audience and Marlon and JMI, you know, we're in the middle of, you know, potentially a private buyer's market. And, you know, if your investment horizon is 2 or 3 years out, I think you should be in the market right now.
Paul, are you feeling that confidence?
So we're private market investors. In making new investments in private companies today, we have a lot of concern about what's their ability to grow their business in '09. So we too start bottoms up, not top down. But there is a lot of question whether now's the right time to invest or 6 months is the right time to invest. There's also a lag.
When is the right time to invest, now or 6 months from now?
I mean, we make individual investments. We don't buy an index. But if you were going to invest now, you've got to have a high degree of confidence in somebody's '09 plan. And in times like that, that's hard to do. And I think that the other thing is that there's a valuation lag in private markets. These entrepreneurs, particularly in growth companies, they don't realize that the market has gone down 40%. So there's a lag there.
In terms of expectations, what kind of a discount would you expect to see between a private and a public company now?
Big one. But the private companies are growing so much faster. We look at it, they're growing much faster than the market. So you can't, they're not really apples and apples. But certainly the valuations in growth equity got very high, both on a revenue multiple or an EBITDA multiple. And you know, they don't see when you talk to entrepreneurs every day like these guys do, they don't see the lag in terms of values.
Josh, tell us, are the entrepreneurs you're talking to, what are they thinking in terms of values?
Well, Paul's right. We're the first line of defense for people like Paul. We provide that kind of rational view of the market and say, look, you know, last year's multiples are last year multiples. What really matters is this year multiples and this year's growth rate. And that conversation usually can be had, and generally with boards, they present it in a unemotional, thorough manner. We have found entrepreneurs and boards do listen to us, especially in this market. Actually, to be perfectly frank, I think we're having more success having that conversation today than we were a year ago and 2 years ago. Because today, you know, we can point to various headlines in the paper and tell them go home and read the paper. You know, this isn't just Revolution Partners' viewpoint. This is really the market.
Very interesting. You know, it's been a tough year for Treasury Secretary Henry Paulson. I feel like Butch Cassidy and the Sundance Kid, he said recently. Who are these guys that just keep coming? What has he done right and what has he done wrong during the crisis? Josh, you want to start up there?
I'll start that. I've followed a little bit of this. I think Paulson, I think he gets a little bit of a bum rap. And by the way, I don't own Goldman stock and I haven't worked for Goldman. But I think he was thrusted into a position that there was no training for having to deal with what he's had to deal with. I think, I think like anybody, he's made some mistakes, but I give him a lot of credit. I think he tries to correct those mistakes. And then after seeing the wisdom of a better path, he goes for that. I give him a lot of credit for doing that.
Anybody else on the take on this? What has Paulson done right or wrong?
I think you should get credit for, for example, in the AIG transaction, going